financial management. So if your specialization is banking and finance or financial management, then you will definitely know why you will have to learn financial management. I don't have to tell you. But if your specialization is something different, then why should you, who has opted for maybe general MBA or MBA in human resource management or operations management, something like that, learn this financial management? That would be the first question when you start learning financial management, right? So if you have ever had this question in mind, then let me tell you that learning financial management as part of an MBA program, or I wouldn't say it an MBA is essentially required. Learning financial management in general equips you, or rather whoever is learning, right, equips us with all the essential skills that are needed to analyze, understand, and make strategic decisions regarding our financial resources. Correct? So whether it is our personal finance or the financial resource of an organization, financial management is essential. It helps you to think smart, in one way understand money and how money can be managed perfectly to get the maximum returns, which is very, very important when it comes to doing well in business and management. Correct? Because it is a very important and highly limited resource, finance. We will start our journey with an overview. Okay, we will gather a basic understanding of financial management concepts like time value of money, risk and return, and how the securities can be valued. And then we will delve deeper into figuring out the cost of capital, the different investment appraisal methods, and managing working capital. That is how we will go through with this financial management rapid roundup. And after that, we will start exploring financial markets, the various sources of finance, and how companies can decide their capital structure and analyze the leverage. What is leverage? We will come to it later, right? In detail, we will come to it. And we will also cover dividend theories, dividend policies, and then we will finally conclude our session with a discussion on the emerging topics in financial management like behavioral finance or financial restructuring and all. So if you are new to this channel, I am Anu, your guide and facilitator for this particular course. I run this small but growing YouTube channel named Anu's Classroom, which is aimed at providing IGNOU students overcome the limitations of distance learning by providing quality content that will not just help you pass your exams with good grades, but also understand the concepts well so that you can become better managers. So as I said, this particular course, we will be covering many things, starting with an overview of financial management, going towards the cost of capital and investment decisions, financing decisions, dividend decisions, and emerging issues in finance. So totally there are 15 units which are divided into 5 blocks. Okay. So without much ado, let us directly start our discussions on this. Right. So as this is a second semester course, this is an extension of the MMPC 4 accounting for managers from semester 1. So in case you have the time, I know the exams are like right at the doorstep, right? But in case if you have time, it will be great if you can brush up the concept of MMPC 4 before starting out with MMPC 14, right? We'll be having a rapid roundup of MMPC 4 also in the channel. So you can either go over there and you can just brush up quickly on the topics, or if you don't have time, then don't bother with all those things. You have already written the exam, you have already studied. Whatever you remember, let us start ahead with that itself, right? So before we start our discussions, before we dive deep into it, I kindly ask you to take a moment and ensure that you have subscribed to the channel and enabled the notifications, because in doing so, you can ensure that you will never miss an update from Anu's Classroom. And this way, you can fully utilize all the resources which I provide to support your journey towards earning your postgraduate degree also from IGNOU. And definitely this is a channel which I started to help you guys out, so feel free to leave your comments, questions, or suggestions. I'm here to help you out, and I will do that to the best of my ability. So don't hesitate to ask anything, but just remember to keep your comments respectful and professional, like you would in your future managerial role. That is the only ask from your end for me. So let us start now. This is a rapid roundup session. We will be covering all the 15 units, all the important concepts, but in no way this is an in-detailed session. Okay, if I have to teach you all the 15 units, it's going to take much more time than this particular video can afford, right? So this is a rapid roundup. Please do keep in mind. As we all know, financial management, it is the lifeblood of all our business activities, right? So it is therefore a very vital aspect of organization's success also. And as future managers and maybe even business owners, it is very crucial that you understand the basics of financial decision making. Financial management covers a very broad scope of activities ranging from meticulous planning and organization to decisive control of an organization's financial resources. Whether it is budgeting, investment analysis, risk management, each facet plays a crucial role in shaping the financial landscape of a company or of a business. So let us dive into the intricacies of this financial management's objectives. Okay, so mainly you can think of two major objectives of financial management, that is profit maximization and wealth maximization. So let us look at it, and let us also try to understand what are the key differences of these two approaches or these two objectives of financial management. So profit maximization actually focuses on the short term gains. Okay, the emphasis is on the short term gains, and it is more concerned about the immediate returns to shareholders. If you get more profit out of a business, the shareholders will get more dividend. But when it comes to wealth maximization, of course we need, if we have to maximize wealth of a firm, definitely there has to be profit. But when you talk about wealth of a firm, you are talking about how much assets the firm has. If it is just simply profit and you're just giving out all the profits as dividends to your shareholders, to your investors, the business assets, even though is having higher returns, is not growing in terms of its own wealth or its own assets. But when the financial management is done in such a way as to increase the assets of the firm, then we tell it as the wealth management objective. Okay, it takes a more holistic approach. It aims to maximize the present value of the expected returns over the long term. So over the long term, definitely the shareholders' wealth is going to increase. Maybe we might not get enough dividends at present, but if the company on which our holding or our shares have become expanded, like if it is growing, then naturally the value of our stock increases, right? So the wealth is increasing. I hope you understood the concept of profit and wealth maximization. So this is the difference here. Like for example, say if Infosys, you take Infosys today, when they started, or even Colgate, we all know about Colgate, right? How many of you guys use Colgate as their toothpastes? See, when they started out, when they came into the stock market, their IPO price, and today where their stock price is because of wealth maximization. What if at that time, instead of expanding Colgate, they decided to give out all the profits as what you can say dividends or something to their shareholders, then such an expansion would not have happened for Colgate, right? Or you take Infosys, TCS, any company, Tata Steels or Reliance, any company you take, if the company has grown, it is because of wealth maximization, not profit maximization. Okay, so now as aspiring financial managers, it is also important that we have a clear idea of the important role a financial manager plays in the corporate enterprise. It ranges from estimating capital requirements to managing the liquidity and engaging in strategic decision making. The responsibilities of a financial manager is very much vast and impactful. You must understand. Our decisions, we as financial managers, our decisions are going to shape the financial health as well as trajectory of the organizations that we serve. Trajectory of the organization means how the graph of that organization, whether it is going to go up or whether it is going to go down. However, definitely navigating these complexities of financial management is not coming without its own challenges. It is not easy, right? It has its own challenges. And the most important challenge is the dynamic landscape of the Indian context. From navigating complex regulatory environments to addressing the limited access to skilled professionals and most importantly funding, we must be equipped to tackle these obstacles with resilience and ingenuity. And moving ahead, we will be learning more about these challenges so that we are equipped to meet them for the betterment of our own organizations. Okay. So now let us dive into the concept of time value of money. Okay, TVM. It is a fundamental principle in finance which greatly influences our financial decisions. So in essence, what this time value of money says is that money available today holds more value than the same amount in the future because of its potential earning capacity. Like for example, if somebody asks you whether you want 100 rupees today or 110 rupees tomorrow, you should be accepting the 100 rupees today. Why? Because 100 rupees today is more valuable than 110 rupees tomorrow. What if tomorrow doesn't come? That is a big risk there, right? You get it today, you can do many things with it. Maybe you can invest it, maybe you can take a lottery ticket. What if that lottery ticket clicks, right? So all you have to understand about time value of money in a nutshell is money today is worth more than money tomorrow, okay, because of its potential earning capacity. So as I said, consider if you were given a choice between receiving 100 rupees today or 110 rupees a year from now, which one will you choose? You should be choosing the money today because it can be invested and earn returns over time. So that is basically the essence of time value of money. So now let us explore this relevance of time value of money in the financial decision making. Firstly, in investment appraisal, time value of money helps us evaluate the profitability of our potential investments. How? By comparing the present value of the cash inflows with the initial investments. So how that happens is, say for example, today you have 100 rupees. You decide to invest it in some, say, let's say you are running a juice shop, okay. So currently what you have is a manual juicer wherein you take a mosambi or an orange, you cut it in half and you manually with your hand, you try to squeeze it and get the juice out of it. Now somehow you manage to get 100 rupees. Whether you're going to invest in a juicer or whether you're going to invest in let's say something else like some other equipment, or maybe whether you're going to get yourself a good pair of knives, depends upon your, that is a financial decisions that you will be taking, right? So how will you choose which option to take, or whether you're going to get yourself a faluda with that 100 rupees? You will choose, if you are a wise person, if you are financially wise, which is what our course is trying to make you financially wise. You should be weighing the pros and cons of investing in all these things. If you buy a faluda for that 100 rupees and drink it, tomorrow that is a money spent, right? That money is spent. But if you use that 100 rupees and get yourself a juicer, an automatic juicer or something, maybe on EMI, because definitely 100 rupees is not going to get it in full price, maybe you'll be able to make more juices. More juices means more sales. More sales means more money. So which is financially wise to invest it in a juicer, right? How are you getting it? How are you understanding that this is better? You're thinking about the future returns that today's 100 rupees is going to give you, right? That is time value of money right there. Okay, so it guides us in making informed decisions about where we have to allocate our resources. So that point went, if that point went over your head, then again don't worry. I'll try to break it down in little more simpler. I hope this will help you. Imagine you're thinking about investing in a business or a project. Okay, so you will definitely want to know if it is going to make you money in the long run. So evaluating the profitability of this investment means figuring out if the money you will make from it in the future, whether it is going to be worth more than what you are putting into it right now. So again, let us say you are considering to start a lemonade stand. You will need to buy lemons, sugar, cups and other supplies. Maybe it will cost you around 100 rupees upfront. That is going to be your initial investment. Now, you expect to sell lemonade every day and make some money from it. But you are not sure if it is worth the effort and the money that you are putting in. So this is where comparing the present value of cash inflows will come in. So it is like asking, if I take all the money I expect to make from selling lemonade in the future and bring it back to today, then how much is it worth? Is it worth more than 500 rupees or is it going to be less than 500 rupees? Okay, so this is what helps you see the potential earnings from your lemonade stand, whether it is enough to cover your initial investment and give you a profit or not. And if the present value of your future cash inflows, that is, future cash inflows means money that you will make from selling the lemonade in the future, that is future cash inflows. In the future, what money you are going to get. Okay, if it is higher than your initial investment, that is the 500 rupees that you spent on your supplies, then your investment is profitable, and it means that the lemonade stand is likely to make you more money in the long run than what you put into it initially. So, evaluating this profitability of potential investments by comparing the present value of cash inflows with the initial investment is essentially all about figuring out if your future earnings are worth more than what you are investing right now. So, it will help you make smarter decisions about where to put your money to get the best return. Secondly, so this was one relevance, right? Secondly, this time value of money plays a crucial role in determining the cost of capital. Now, what is cost of capital? Businesses use this cost of capital to assess the cost of financing and investment opportunities, guiding decisions on how to fund their operations. Okay, cost of capital. We'll come to cost of capital in detail later on. Now, thirdly, time value of money assists in risk management. How? By understanding the time value of money, we can assess the risk that is associated with the future cash flows and determine the appropriate discount rate for risk adjustment. Moreover, time value of money guides capital budgeting decisions also by helping us evaluate long-term investment projects. Whether it be purchasing new equipment or expanding operations, the time value of money can provide a framework for making sound investment choices. Lastly, in financial planning, this time value of money aids individuals and businesses in making informed decisions about savings, retirement planning, and debt management. And by understanding the value of money over time, that is nothing but time value of money, we can plan for our future financial well being effectively. So, in summary, the concept of this time value of money is not just a theoretical construct, but it is a very practical tool which shapes our financial decisions. And whether you realize it or not, we have all been using this time value of money. Maybe not exact calculations, but we are using this time value of money to make our financial choices every day, day in and day out, whether it is in your organization or in your business or in your daily life, right? So, by grasping its significance, we can empower ourselves to make sound investment choices and manage risk effectively and plan for a secure financial future. Okay, so now as you might all be aware, this is a theory. This is not a purely theory paper, right? This is a paper wherein you will have to put some numericals can be expected. So I'll try my best to cover at least a few common type of questions which have come up in the past, and let us try to find out the answers for that. Just to give you an intro, I'm not going into depth into each and every type of question. That is not possible. It is not in scope for this video, but at least I thought at least a couple of questions can be done. Okay, so let us try to do this particular question which is related to time value of money. Okay, so it is simple. Suppose you invest 1000 rupees today, and this first year this particular investment of rupees 1000 will give you 12% returns. Second year it will give you 6% returns. Third year it is going to give you 8% return. Okay, so how much would this investment be worth, assuming we are not doing any withdrawals? That is the question. So what is asked here is we are asked to find out the future value of the investment. So in order to do that, we can use a formula for compound interest. So what is this formula for compound interest is future value is equal to present value into 1 plus the rate of return raised to number of years. So this is the formula for getting the future value. Simple formula, compound interest formula, right? We have all studied it in our school. If you don't remember, please keep this in mind. Okay, if you have to find the future value of an investment, this is the formula that you have to use. So what is the present value? It is given to us, it is 1000 rupees. So 1000 is the present value. Okay, so we have been given three returns, right? First year it is 12%, second year it is 6%, third year it is 8%. So this is R1, rate 1, this is rate 2, and this is rate 3, R3. Okay, so first year, so N also we have first year, so this is N1, the second year, so this is N2, and third year, this is nothing but N3. So we have to calculate the future value for each year, and then we have to sum it up. So the first year, right, future value will be 1000 into 1 plus the first rate of interest, that is 12% raised to 1, first, because it is first year. Okay, so we will get one particular amount of money. Now we are said that no withdrawals are made. Okay, so the second year the present value is not 1000, but whatever we have got with 12% interest from the first year, that is the investment in the second year. Okay, so the second year is present value is the future value of from first year, right, into 1 plus the 6% whole raised to 2, because n is, sorry, it is not 2, but this is for the second year, so n is again 1 only. So this is a mistake we all make. N value for the second year is not 2 but rather 1. Why? We are calculating it for this 1 year, the second year only. Okay. Similarly, the third year f future value 3 is, it will be the second year's, after second year what we got, right, that into 1 plus this 8% whole raised to 1 for the third year. Okay, so this particular FV3 is the finally what is going to be in your hand is this FV3. Why? Because no withdrawals were made. If withdrawals were made, then definitely whatever was withdrawn we'll have to have reduced from it. But since no withdrawals were made, then it is easy for us to calculate. So this is how you have to approach such a question. I hope this is clear. Okay, so yeah, I just wanted to bring this to your attention. So if a question comes like this, I hope you will be able to answer. So next is risk and return. So when we invest, there are two main things that you have to consider. One is the expected return and the realized return. That is the return that you are expecting and the return that you have actually got. Almost always, like 90% of the time, what you expect, you will not get. You will get something lesser. Rarely 10%, whatever you have expected, you will get more than that. That is a rare occurrence. Happens mostly because we underestimated the returns, right? Yeah, so expected return is like guessing how much money we might make based on the past trends, while realized return is the actual money that we end up with. So we need to understand risk and uncertainty. Okay, risk is knowing the chances of losing money. What is the risk? How much money can we might lose? That is what risk. Knowing the chances of losing money. But what is uncertainty? It is not being sure what will happen in the future. So risk in investment comes from different places. It could be market risks, right, when the economy changes. It could be interest rate risk, which comes from interest rates going up or down. There could be business risk about problems that could happen inside a company, right? So to make smart investment choices, we need to know how to measure return as well as risk. Return tells us how much money we might make, whereas risk shows us how likely it is that we might lose money. And by understanding this risk and this return, we can make better decisions about investments and try to make more money while we keep our risks low. This is also one chapter from which questions, numericals might come up. So this is one such question. Let us see how we can answer such a question if it comes, right? So Prashant here is considering investing in a security that has the following distribution of possible 1-year returns. Okay. So what is the probability of occurrence and what is the possible return? We have two questions that we need to answer. First is, what is the expected return and standard deviation associated with the investment? And second is there much downside risk? Can you tell? How can you tell? Okay. So we have to first find the expected return and the standard deviation, right? So to calculate this expected return, we have to first calculate to calculate this expected return, we can use this particular formula, that is sigma I is equal to 1 to n pi into Ri. Okay, that is the probability of occurrence. This is pi into the possible return. This is Ri. Sigma 1 to n, that means, so this is 1, 2, 3, 4, 5. So here in this case, sigma I is equal to 1 to 5, P of I into R of I. So that is nothing but 0.10 into minus 0.10 plus 0.20 into 0.00. See, this into this plus this into this plus this into this plus this into this. This is how you can calculate the expected return. Okay, I'm not calculating it for you, that you can do. I'm just trying to tell you how we can calculate, that is all, right? That was the first question. Now comes the standard deviation. We have to find out what is the standard deviation associated with this investment. So the standard deviation is nothing but the root of sigma I is equal to 1 to n, I is equal to 1 to n pi into Ri minus the expected return. Okay, the expected return, this is ER, expected return square. I use a different color. Okay, so that is sigma I is equal to 1 to n p of I into r of I minus expected return square and the whole thing under root. This is the standard deviation. Okay, this is how you find the standard deviation. So we already found out the expected rate of return, right, using this particular formula. All we have to do is substitute it in this formula. We know p of I, we know r of I, we can find it out. We can find the standard deviation. Okay, now to assess the downside risk, we have to compare the standard deviation, that is this standard deviation, to this expected return. And if the standard deviation is relatively high compared to the expected return, then it is suggesting that there is considerable variability in returns. That means it is an indication of higher downside risk. That is, you could lose money. But in this case, I want you guys to find out this expected rate of return, this expected return and the standard deviation by substituting in these formulas, and I want you guys to comment whether you found that the downside risk is high or not. I want you guys to answer that. But how you can answer it is, you have to compare your standard deviation with this expected rate of return and or expected return. And if your standard deviation is high compared to ER, right? If your standard deviation is high compared to your expected return, then there is higher, downside risk. So how much downside risk is there, whether it is high or not, you have to tell me. But this is how you tell, okay? Let us now dive into the world of valuation, which is all about figuring out how much something is worth. So imagine you are trying to decide whether you have to buy a new phone or not. So you would want to know its value, correct? Well, that is what valuation is all about. But here, instead of phones, we are talking about business, right? Assets, maybe even stocks. So what is the purpose of valuation? Why do we care about valuation? Imagine you are trying to sell your bike. Definitely, you will want to get the best price for it, correct? So the same goes for businesses and assets also. Valuation helps us figure out the best price or the value for something that we might be buying or maybe even selling. So it is like having a price tag on everything in the financial world, this valuation. So what is the impact of this valuation now? Let us talk about how this valuation is going to affect things. So imagine you are buying a used car. If you don't know its true value, maybe you might even end up paying too much for it. Valuation helps us avoid such things by giving us a fair idea of what something is really worth. It is like having a compass to guide us in the right direction when we are making financial decisions, that is. Now, how do we figure out the value of something? Okay, I agree, valuation means all these things, it is very good, blah, 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 price tag stuff. How do I determine the value? That is the question, right? So there are a few ways that you can value things. Okay, you can think of it like making a cake, right? Making a cake, you can take for example. Like, see, you can follow different recipes. There is no one right approach to cake which says cake has to be made like this. No other way you make cake, you cannot call it cakes, nothing like that, right? Different bakers have different approaches, different recipes for different cakes, and they all turn out to be cake itself, right? Maybe you might like some cakes, maybe you won't like some cakes, but basically there is no just one right recipe for a cake, right? So it is like that. We have multiple recipes to figure out the value of various assets. So there are three key approaches that we have to be aware of: the income approach, the market approach, and the asset approach. The income approach is like predicting how much money your lemonade stand, you remember our lemonade stand which we made during our time value of money time? Yeah, that exact lemonade stand. It is like predicting how much money that lemonade stand will make over the summer. That is what income approach. How much money are you going to make from it? And by looking at the future earnings, we can figure out the value of a business or an asset, right? Second is the market approach. So that you can imagine you are buying a house, okay? So you will definitely be looking at similar houses in the area to see how much those houses are selling for, right? If you are buying a plot, you will see how much in lakhs percent it is going, general market rate, what is the going rate, you will see, right? That is the market approach. We compare our asset to similar ones in the market to figure out its value. Then we have something called as the asset approach. This is like adding up all the ingredients in the cake to see how much it is worth. So we look at the value of the individual parts of an asset or a business to figure out its total value. Okay. So why does all this matter? Why are we talking about valuation? Imagine again that you are starting a lemonade stand. Okay, you need to know how much it is worth to investors so that they will give you money to buy lemons and cups, right? Suppose say if it is your child who wants to set up the lemonade stand and he is asking, coming and asking, ma or pa, give me 500 rupees, I want to set up a lemonade stand. You will think. Otherwise, if you see a fancy bag which you know, or a fancy something which you like, which is for 1,000 rupees, maybe blindly you will invest that 1,000 rupees over there. Not even invest, spend that 1,000 rupees over there. But if your child comes and asks 500 rupees, you will think 100 times, even 500 times before giving it, right? What you are going to do, what is your plan, all those things, right? Why? Because we are investing our 500 rupees over there. We need to know whether we are going to get it back or not, right? So valuation is what helps make smart financial decisions, whether we are investing in business or investing in stocks or buying a car. Suppose say your child is going to put up a lemonade stand, you will think whether he'll be made fun of, whether some people are going to buy or not, whether it is going to be enough, whether 500 rupees, whether he'll be able to make that 500 rupees back. All these things you will think. Maybe you will even give discouraging words also, so that that kid loses his heart and doesn't ask you money and doesn't take it up, right? Many things we do. So that is what we are trying to figure out, the value there. So valuation is simply put like having a roadmap in financial world. Okay, it helps us make informed decisions, avoid paying too much, and ensure that we are always getting a fair deal. Now, before we move ahead to the next topic, I also want to bring your attention to the 3-step valuation process. Okay, so you can imagine it like making a sandwich. You will need the right ingredients. You will need to follow the right steps. Only then you can make it tasty. So the first step here in the valuation process is the economy analysis. So what we are going to do over here in this economy analysis is we look at the big picture, the economy. It is like checking the weather before you are planning a picnic, whether it is going to be summer there or winter there, so that we can, if required, we should take jackets, or whether if it is going to be rainy, maybe we will schedule it for a different month, or if it is going to be too hot and parched, then maybe it is not the right time, things like that, right? So we are looking at things like the jobs, the prices, government rules to see how they might affect our investment. That is what economy analysis. The second step is industry analysis. We zoom in on the different industries, like maybe cars or phones. It is like picking the right ingredients for our sandwich. We check which industries are doing well, which might need a bit of help, all those things. And the third step here is stock analysis. That is, we look at individual companies like maybe Apple, or if it is phone, then maybe Apple, or if it is cars, maybe Tesla or Mahindra, whichever. It is like tasting the sandwich to make sure it is perfect. So what we do over here is we check things like how much money they make and whether they have good leaders or not. That is stock analysis. And by following these 3 steps, economy analysis, industry analysis, and stock analysis, we can make smart investment choices, just like making a tasty sandwich or a tasty samosa. So next time you're buying a bike or starting a business or even investing in stocks, whatever it is, remember the power of valuation and try to apply the valuation process, and Sarvamangalam Bhavantu to you. Okay. So early on, we talked something about cost of capital, and I promised you that we'll be dealing about cost of capital in detail in the upcoming minutes, right? So here we are. Let us explore the concept of cost of capital. So imagine you are starting a business, or maybe even managing an existing one, doesn't matter. Okay, but imagine. So you need money, definitely, to invest in new projects. You might be thinking about expanding your operations, or maybe even simply keeping things running smoothly. So where do you get that money, right? And how much does it cost you? You remember Thanos, right? To get the soul stone, what did it cost you, right? So even business, to keep it running or expand, you need finance, and to get that, what is the cost that you might have to pay, right? That is nothing but the cost of capital. It is a very fundamental concept in finance which helps businesses make smart financial decisions. Essentially, It is the minimum rate of return a company needs to earn on its investment to maintain its value. Think of it as the price tag on money, right? Like your investment, if you are taking a loan to fund your business, the cost of capital on that is the interest rate plus many other things to keep your business afloat, right? So it is the cost a company pays for using the funds from investors or even lenders. So now let us try to break down the components of this cost of capital. Okay, there are mainly three parts. First is the risk-free rate of return. Okay, risk-free rate of return. It is the baseline return that investors expect without taking any risks. So it is like the guaranteed minimum you will get from the safe investment, like maybe government bonds and all. Okay, then the second is the premium for business risk. So every business venture definitely involves some level of risk, that is for sure. So investors do expect an extra return to compensate for the uncertainties that are associated with a particular business or a particular industry. So this premium reflects that additional risk. Okay, that is the premium for business risk. Why should I take that risk for your business? What am I going to get because I took that risk? That is the premium for the business risk. Third component of the cost of capital is premium for financial risk. That is, how a company finances its operations also affects its cost of capital. Like, for example, if a company relies heavily on debt, loans, then investors may demand a higher return to offset that increased financial risk. So, how do we calculate the cost of capital? We add up all these three components. RO is nothing but the risk-free interest rate. B is nothing but the premium for business risk. F is nothing but the premium for financial risk. You add all these three components up and you have the cost of capital. Okay, that is nothing but K. K indicates the cost of capital. So anyway, but why should I learn about this cost of capital again? Like, why does it matter? What is the importance? Well, it is definitely, you must understand and you must realize this cost of capital is like a yardstick for evaluating investment opportunities. Like, if a project can't guarantee returns that are higher than its cost of capital, then it is not worth pursuing. Okay, a smart investor will not pursue an investment which cannot generate returns higher than its cost of capital. So the cost of capital also helps determine the company's overall financial health and guides the decisions on financing and investment strategies. Now let us debug some of the misconceptions also about the cost of capital. Some people think that this cost of capital is just a theoretical concept or that it is same as the dividend rates, and some people might believe that using retained earnings is free money or that debt financing always leads to a lower cost of capital and all. But these are incorrect and it can lead to poor financial decisions. Okay, so cost of capital is not just something that is theoretical. It is definitely different from dividend rates, and retained earnings are not free. Debt financing doesn't always lower the cost of capital. These are all misconceptions. Don't fall for it, right? So in summary, cost of capital is a crucial concept in finance. It helps businesses assess investment opportunities, make informed financing decisions, and ultimately create value for shareholders. So I hope you got a basic understanding of the cost of capital, which is all that I wanted to from this rapid roundup session. So let's move on to the next concept, that is investment appraisal methods. So imagine you are running a company and you want it to grow and do well in the market. Definitely nobody wants their company to go down, right? So you've got some money to invest, but where should you put it? Right? That is the question. Where should you put it? Investment decisions are all about choosing the best place to spend your money, to choose the best place to spend your money and to make your company stronger. Maybe you want to expand your business or buy new equipment or try something new to attract more customers. Whatever it is, you have got to think about how much money you will need, how much you will make, and how you will manage the cost. And plus, you have got to decide whether it is better to buy stuff outright or rent it or maybe lease it, whatever it is. But here is the tricky part. Making these decisions is not always easy. As if we didn't understand that, right? Definitely, it is not easy. There are a lot of unknowns, like how the market might change or if new technology will come along and shake things up. We never know. So, that is where investment appraisal comes in. It is like doing the homework to figure out if an investment is good idea or not. So, how do we do it? We have got different ways to crunch the numbers and see if an investment makes sense or not. For example, we might look at how quickly we'll get our money back with something called as the payback period, or we might use the net present value to see how much money we will make in the long run, considering how time affects the value of money. But here is the thing to remember: predicting the future is not easy. We can't always know for sure how much we will make, money we will make, or how long our things are going to last. New inventions or changes in what people want can all mess up our plans. So that is why we have got to be careful and use our best judgment when making investment decisions. So, to sum it up, investment decisions are super important for companies because they help them grow and succeed in a competitive world. And by understanding how to make these decisions and using smart methods to figure out if an investment is worth it, we can set our companies up for success. Working capital management. It is a cornerstone of financial management for any business. And before we understand how it is managed, let us understand why working capital matters. Simply put, it is the lifeblood of a company's day to day operations. Think of it as the funds that is needed to keep the wheels turning, covering everything from paying suppliers to meeting the payroll. Without it, a company can't function smoothly and might even face solvency issues. Solvency means the ability to meet the financial obligations, like paying bills or debts, with the available resources. So, in simple terms, solvency is about whether a company has enough money to cover its expenses or not. If a business faces solvency issues, then it might struggle to pay its bills on time, leading to potential financial troubles or even bankruptcy. So, effective working capital management is very much vital for navigating the ups and downs of businesses and ensuring long term success. So, talking about working capital management, now that I've given you a brief on it, we have to also talk about, in the same breath, about operating cycle. So this operating cycle is the time a company takes for converting raw materials into finished goods and then into cash. So understanding this operating cycle helps us manage our working capital efficiently, ensuring that funds are tied up for the shortest possible time. There are two key concepts of working capital: gross working capital and net working capital. Gross working capital refers to the total current assets, whereas net working capital is the difference between the current asset and the liabilities. Both these working capitals, gross working capital and net working capital, are crucial for maintaining the liquidity and supporting business operations. Now, moving on to the different types of working capital, we have fixed working capital and fluctuating working capital. Fixed working capital is the minimum that is needed for day-to-day operations, while fluctuating working capital varies with the changes in productions and sales. Both of these are essential for meeting the short-term needs and seizing the growth opportunities. When it comes to managing working capital, there are two main approaches also. One is the traditional approach, whereas the other is the operational cycle method. The traditional method or the traditional approach focuses on individual components like inventory or receivables, while the operational cycle method looks at the broader picture, considering factors like production policies and inventory turnover. Measuring working capital definitely can be tricky, but it is essential for understanding a company's financial health. Ratios like the current ratio or quick ratio helps us assess the liquidity and efficiency, guiding us in making informed decisions. Inflation also can complicate the working capital management, but careful planning and disciplined strategies can help mitigate its effects. It is crucial to maintain the right balance of cash and investments to ensure growth and stability. Finally, managing cash flows is key to effective working capital management. By optimizing collections, maintaining an optimal cash balance, and investing wisely, companies can ensure that they have funds that they need when they need them. All in all, working capital management is a multifaceted approach of financial management which requires careful attention by strategic planning. And by understanding its significance, concepts, and various approaches, we can develop the skills needed to drive that financial success in any organization. So I know it is a lot to process in a short time. So, feel free to rewind as many times as required to grasp everything about working capital management. It is a very important concept, especially if you have taken finance management. Working capital management is a must for you to understand. So, put your foundations strong so that you can build a very strong career ahead, right? So, financial markets. Financial markets are, you can think of as the beating heart of an economy, like laptop, pulsating with the flow of funds from those who have extra to spare to those who are in need for productive endeavors. So, people who have extra funds meet people who need funds in the financial markets. So, imagine you have some extra money that you don't need right away. Maybe it is sitting in a savings account. Financial market will provide you a way for putting that money to work. You have heard the term, right? Make money work for you rather than you working for money. How do you make money work for you? Not by spending. Spending means you have the money, you spend it. That is, you give it out and you get value for it just once. Whereas investing, that money grows. Okay, it gives you returns. It keeps on giving you returns. That is when money works for you. Spending is not same as investing. If you, like for example, you buy a bag or you buy a laptop, unless you are using that laptop for work, or if you are a designer, you are using that laptop or you are using that phone to connect with your clients and you are getting money in return, then that laptop becomes an investment. But if you are buying a laptop to see some movies or things like that, then it is a spend. That laptop is not going to give you any more value addition in terms of finance. Okay, so financial markets provide a way for you to put your extra money to work. You can invest it in stocks or bonds or any other financial instruments through these markets, allowing it to grow over time. On the flip side, if you are a company that is looking to expand your operations but you need funds to do so, then financial markets offer a platform to raise capital by issuing stocks or bonds to investors. Now let us break down the different types of financial markets. First up, we have money markets where short-term funds and financial assets are traded. You can think of it as a place for quick loans and short-term investments. Then there are capital markets where long-term securities like stocks and bonds are bought and sold. Equity markets, specifically, they deal with stocks, whereas debt markets handle bonds. Then have you ever heard of something called as derivatives? Derivatives. Derivatives are financial instruments which derive their value from an underlying asset, providing a way to manage risk. Commodities market is where goods like agricultural products or metals are traded, while in the foreign exchange market, it deals with the currencies from around the world. So these are the various types of markets, financial markets that are available to us. Now, who are the players in these markets? In India, it is a very diverse group, including banks, mutual funds, insurance companies, and even the Reserve Bank of India, RBI. These entities play a very crucial role in raising funds and investing them in various financial instruments. Ultimately, financial markets grease the wheels of the economy, allowing funds to flow where they are needed most. They promote economic efficiency, they drive economic growth, provide opportunities for individuals as well as businesses to thrive. So, the next time you hear about the stock market or bond trading, remember it is all part of this intricate web which makes up our financial ecosystem. Sources of finance. So previously we have discussed as to how different financial institutions and various financial markets facilitate the organizations in raising funds from the market. So here in the next few minutes we will be discussing some of these instruments or sources that these markets, our financial markets and institutions, provide us to finance our businesses. So at the heart of our discussion lies the classification of sources of finance, a fundamental framework which is based on factors like time, ownership, and source of generation. So our focus here revolves around the period classification, which divides the financing into three categories. Okay, long term, medium term, short term. Okay, so on the basis of period, it is long term, medium term, short term. This is how we will be mainly looking at finance. On the basis of ownership or source of generation, there are different classifications, but right now let us focus on this based on time period. So long-term sources of finance are the lifeblood of companies with aspirations for sustained growth and development over extended periods that exceed 5 years. So if they need the finance for more than 5 years, right, they are looking at, or they need long-term sources of finance, because any other source of finance you will have to repay within 5 years, under 5 years. Okay, so these funds are typically channeled towards acquiring fixed assets or undertaking projects with enduring impacts on corporate earnings. Among the array of long-term sources are equity, debt, asset securitization, and venture capital, each offering distinct advantages and risks for discerning entrepreneur. Then the next is medium term finance, which spans a duration of 1 to 5 years and serves as a bridge between the short term operational needs and long term strategic objectives. So companies utilize this medium term finances like lease financing or hire purchase or medium term loans to fuel expansion and diversification initiatives, leveraging these sources to navigate through critical phases of growth. In contrast, we have the short term finance, which caters to the exigencies of immediate financial requirements. Okay, typically extending for periods less than 1 year. It is essential for financing working capital needs. Short term sources like, say, trade credit or commercial paper, factoring, and public deposits are all short term offerings which offer companies the flexibility as well as the agility that is required to navigate through the dynamic market conditions. Moreover, sources of finance can also be classified, as I said earlier, based on ownership and control, distinguishing between internal, that is self owned, and external sources. Owned sources generated from within the organizations could be retained earnings, equity capital, preference capital, fostering autonomy and self reliance. All these owned sources foster autonomy and self reliance. On the other hand, external sources encompass loans from financial institutions or debentures or bonds, providing companies access to capital that is beyond their internal reserves. So the choice of financing actually depends upon a thorough evaluation of a company's financial needs, weighing the advantages and disadvantages that are inherent in each source. Long-term sources like equity capital offer permanence and credibility, but it comes with higher risks, while short-term sources like trade credit provide immediate liquidity, but they may entail higher costs in the long run. So are these the only sources of finance available to us today? No, no, definitely not. Emerging sources of finance are also gaining prominence in today's dynamic business landscape, like asset securitization, angel financing, crowdfunding, small business credit cards. All these things are new sources of finance which offer innovative pathways for startups and small businesses to raise the capital, and is revolutionizing the financial paradigm with their unique blend of accessibility and flexibility. Have you seen angel investors in Shark Tank? You have seen Shark Tank. It's a very good show to watch, especially if since we are in this MBA domain. So these startups, they come and they pitch their ideas, and these investors, they bargain, right? Okay, I'll fund you, or I'll give you this much for this much stake in the company, and things like that. They are angel investors. That is a new source of funding for upcoming businesses. So as future business leaders, it is always upon us to navigate through this financial jungle and leverage our understanding of the nuances that are inherent in each of these sources to make informed decisions which drive our ventures towards prosperity. And you must be able to understand which you have to take, like in what mix you have to take, how much retained earnings, how much external debt, all these things you have to be very careful about in planning, right? So why? Because you can think of a company as a house which needs to be built. Okay, so to build this house, you will need different types of materials. Some of them you might already be owning outright, like maybe the bricks or the wood, which would be your equity, and some you will have to borrow, like a loan from the bank to buy more materials. That will be your debt. Now, you want to build your house in a way which makes it strong as well as valuable. You don't want to borrow too much, because then you will have a big loan to pay back with interest, which can be tough. But you also don't want to rely only on your own materials, because maybe you won't have enough money to get all the materials you need. So you'll have to figure out the right mix of what you own and what you borrow to build your house just right. Maybe you might use mostly your own materials but borrow a little to speed things up. Or maybe you are confident you can pay back a bigger loan quickly because you know the house will be worth a lot more once it is built. So it all depends upon you, case to case basis, business to business basis. So it is like trying to balance how much of your own money you put into building your house versus how much you are going to borrow. So you want to make sure that your house is sturdy, right? Financially stable. House is nothing but your business here, and it is worth a lot. It is valuable to investors. But you also want to be smart about how you use your resources. So in the end, finding the right balance between what you own and what you borrow is the key to building a strong, valuable house or company which stands the test of time. So this is what the concept of capital structure means for a company also. Okay. So capital structure, it is nothing but a mix of long-term financing sources, a company comprising a company's total capitalization. It is an amalgamation. Typically, it includes ownership securities like equity and creditorship securities like debt, along with long-term loans from financial institutions. So just like what we saw in the example of building a house, the main reason or the main goal behind creating an optimal capital structure is to maximize the market value of equity shares over the long term, ensuring alignment with the interests of regular shareholders who are the ultimate owners of the company. Achieving this objective necessitates a balance among factors like flexibility, control, and solvency. So it is not surprising that the determination of the ideal capital structure is full of challenges. Industry differences, individual company characteristics, and the judgment of decision makers all exert influence, making this process very complex as well as nuanced. Therefore, what works for one company may not necessarily be suitable for another, and that is why there is a need for a tailored approach for capital structuring. From the outset, when the firm is established, we need to carefully consider the crafting of the initial capital structure. Subsequently, management must also set a target structure and make the financial decisions aligned with that vision. And as the firm evolves and operates in dynamic environments, the finance department will shoulder the responsibility of managing the current capital structure effectively. So here factors like flexibility, control, solvency, all these things will come into play, each influencing the decision making process in unique ways. അതായത് കൂട്ടുകാരെ, in essence, the journey to an optimal capital structure is not a destination but continuous evolution. Okay, it is continuously evolving, shaped by the changing circumstances. It is not like you build a structure and you stick to it no matter what, right? As and when the environment of a business is very dynamic, as and when the environment changes, as and when the wind blows, as and when the rain comes, you'll have to make amends to make sure your capital structure withstands the test of time. By recognizing the interplay of factors and embracing a proactive approach, firms can chart a course towards sustainable growth and value creation. So are you still finding it difficult to wrap your head around all this after all these explanations? Is it? Let me know. Okay, so if you are, then definitely go rewind, go through your course materials as much as needed, but just get this concept right. Okay, especially MBA finance people, MBA banking and finance people must get it right. Okay, so leverage. We were talking about leverage while we started talking about financial management in the introduction, right? In the first few minutes of the video, and I said we will be talking about leverages later point. So what is leverage? What is financial leverage? Financial leverage is like using a seesaw. Okay, just like a seesaw can lift you higher with less effort when someone heavier sits on the other end, financial leverage also helps a company boost its returns on equity using borrowed funds. Let's break it down now. Okay, so what is financial leverage? It is using debt or borrowed money to increase the return on equity. Just like adding weight on one side of the seesaw helps you go higher. So how do we measure this financial leverage? We calculate it using ratios like debt to asset ratio or debt to equity ratio and things like that. These ratios show how much of a company's assets or equity is funded by debt. The debt to asset ratio gives a clear picture of leverage, especially when debts are high. It is like looking at the seesaw from a better angle. Whereas debt to equity ratio might overstate the leverage, especially when the debt is high. So it is like having someone too heavy on one side, making it hard to balance. So why does all this matter? Financial leverage magnifies our profits, just like how a heavier person makes the seesaw tip more. But it also increases our risk, making the company more vulnerable to losses. So what is the impact of this financial leverage on our profits? Financial leverage works hand in hand with operating leverage, which will affect the earnings before as well as after interests and taxes. And together they can make profits soar but also plunge if things go wrong. How do we calculate the impact of financial leverage now? We measure the degree of financial leverage to see how changes in sales will affect the net income or earnings per share. So it is like predicting how high the seesaw will go when someone heavier sits on it. And how do we manage this risk which comes with it? Just like how we need to balance a seesaw carefully, companies also have to manage their leverage carefully. Too much debt can make them shaky, scaring away the investors. So financial leverage is like playing on a seesaw of profits and risks. Right? Understanding it helps the companies make smarter decisions to stay balanced and keep their investors happy. Now, dividend. Dividends are those elusive rewards distributed by companies to their shareholders, and they hold a significant importance in the realm of finance. Understanding the theories behind the dividend policies can provide valuable insights for investors who are navigating the complex landscape of the financial markets in India. We shall first look at the traditional theory of dividends, which is a concept which was pioneered by B. Graham and D. L. Dodd. This theory suggests that the shareholders prefer companies that offer higher dividends over those with lower payouts. And according to this view, companies distributing generous dividends tend to gather greater market value. Like if I'm giving to you an example, imagine you are investing in two companies, okay? Company A and Company B. Company A pays regular dividends and provides you with a steady income stream. Meanwhile, Company B reinvests its profits back into the business, aiming for future growth instead of immediate payouts. So, in line with the traditional theory, many Indian investors may prefer Company A due to its consistent dividend payments, providing them with regular income, which is highly valued, especially among retirees or those who seek passive income. Next, we learn about Walter's model, which is crafted by Professor James E. Walter. And this theory delves into the intricate relationship between a company's dividend policy and the internal rate of return and cost of capital. So, this model offers valuable insights into how companies determine their dividend payouts based on their investment opportunities. So, how do I explain this to you? Hmm. Okay, consider a scenario where a local business owner is thinking about their dividend policy. Okay, so they have several investment opportunities available, ranging from expanding their product line to opening new stores. According to Walter's model, this business owner will assess the profitability of all these investment opportunities against the cost of capital. And if the return on investment exceeds the cost of capital, then they might retain the earnings to fund these projects rather than distributing it as dividends. So, this approach aligns with the model's emphasis on the relationship between investment opportunities and dividend policy, which resonates with Indian entrepreneurs navigating growth decisions. Next, we will look at Gordon's model, okay, which is a stock valuation framework that was proposed by Myron Gordon. And this model tackles the problems of dividend relevance and irrelevance, providing guidance on the optimum dividend payout ratios for different types of firms. To understand this, let us envision a startup in India's booming tech sector. So, this company is experiencing rapid growth, attracting investors who are eager to capitalize on its potential. So, according to Gordon's model, if the company's return on investment exceeds the cost of capital, then it may opt for a low dividend payout ratio, or even it could reinvest all profits back into the business to fuel further expansion. So, this strategy reflects the model's proposition that in high growth scenarios, investors may prioritize capital appreciation over immediate dividend income, which is a scenario commonly observed in India's dynamic startup ecosystem. So, our study on the dividend theories will never be complete without the hypothesis by Modigliani and Miller. Modigliani-Miller hypothesis, hypothesis. It's a very important thing. It is a very important hypothesis. You must know about it clearly. So, this hypothesis argues that a company's dividend policy has no bearing, that is, no connection to its valuation. So, imagine, okay, you are an investor in Indian stock market and you are assessing two companies, one which pays generous dividends and another which reinvests all profits. So, according to the hypothesis, in a world with perfect capital markets and rational investors, your investment decisions would be indifferent between the two companies. Whether the company distributes dividends or reinvests profits, its valuation and your returns would remain unaffected. But in reality, Indian investors may still exhibit preference for the dividend paying stocks due to the cultural norms, the taxation considerations, as well as market sentiments. So, I hope you got a basic idea of all these dividend theories, right? Now, let us move on to our next topic, which is dividend policies. We now know that dividends are payments that are made by a company to its shareholders as a distribution of profits, typically as a reward for investing in the company. Dividend policy is essentially the guidelines and decisions a company makes regarding how it distributes its profits to shareholders in the form of dividends. Now, there are several forms of dividends that a company can issue, and each comes with its own implications. So, let us go through them. Cash dividends. Okay, this is the most common form where shareholders will receive a cash payment from the company's profits. Then we have stock dividends where shareholders receive additional shares of the company's stock instead of cash. Debenture dividends. Here, instead of cash or stock, a company may issue debentures to shareholders, which are like long term debts bearing interest payable after a certain period. Then there is something called as scrip dividends. That is, when a company doesn't have enough cash, it may issue promissory notes or warrants to shareholders. Property dividends, which are given out in rare cases where a company may distribute assets or property as dividends. So, these forms of dividends can vary depending upon the company's circumstances and the company's policies. There are two main categories of factors which affect the dividend policy that is adopted by a firm: ownership considerations and firm oriented considerations. Ownership considerations involve factors like the concentration of ownership, shareholders' income requirements, and tax matters. On the other hand, firm oriented considerations include things like contractual restrictions, liquidity needs, and the company's growth plans. External factors such as the state of the economy and tax policies, and internal factors like the nature of the businesses and the composition of shareholders also play a role in shaping dividend policy. Ultimately, the goal of dividend policy is to maximize shareholder wealth while creating the company's financial needs and investor expectations. Companies can adopt different types of dividend policies also, such as stable rupee dividend policy or residual dividend policy, depending upon their objectives and their particular circumstances. Behavioral finance is like a puzzle which helps us understand how people's thoughts and feelings affect the way they make decisions about money. It combines ideas from psychology, economics, and finance to figure out why people sometimes act in unexpected ways when it comes to their finances. Imagine you have a friend who always buys things on sale, even if they don't really need them. That's an example of something we call as a bias. It is when our brains trick us into making decisions that might not be the best for us financially. Behavioral finance helps us understand why these biases happen and how they affect things like the stock market. So, let us talk about some of the key areas within the scope of behavioral finance. First is investor bias and heuristics. This is all about how our brains use shortcuts or heuristics to make decisions about investments. Sometimes these shortcuts can lead us to making mistakes without even realizing it. We have emotional influences like fear or greed and hope. This can have a big impact on how we invest our money. Behavioral finance helps us understand why we feel these emotions and how they affect our financial decisions. Market anomalies. Have you ever heard of something like this? Market anomaly? It is when the stock market does something totally unexpected, like maybe going up or down for no apparent reason. Behavioral finance helps us explain these anomalies by looking at how people behave in the market. Investor psychology. This is all about how our brains process information and make decisions about money. Understanding investor psychology helps us predict how the stock market might behave in the future. Now let us talk about some developments in behavioral finance which have happened over the years. Quantitative behavioral finance is a fancy math. It uses fancy math and statistics to study how biases affect the stock market. Experimental finance is where scientists set up experiments to see how people behave in the stock market. is kind of like a science experiment, you can think. Neurofinance. This is like looking inside our brains with special machines to see how we make decisions about money. Emotional finance is all about how our feelings influence our financial decisions. So there you have it. Behavioral finance in a nutshell. It is a super interesting field actually, which helps us understand why people do things they do with their money. So the next time you're making a financial decision, think about how your brain might be tricking you. And maybe, if not already, you will start making smarter choices. Alright? So that's about this topic. Let's move on to the next one. That is the last topic on MMPC 14, financial restructuring. Alright, so let's talk about corporate restructuring. Particularly, we will focus on financial restructuring. So what is corporate restructuring? It is a process where businesses make significant changes to their operations, maybe through takeovers or mergers, acquisitions, or even financial adjustments. Financial restructuring is one of the key aspects and involves reorganizing a company's finances, including its assets and liabilities. This could mean adjusting capitalization, the structure of debt and equity, the cost of capital, cash flow streams, and more, all with the aim of providing the overall financial health, improving the overall financial health of the firm. Now, there are several methods that companies can employ to restructure their finances. Let us go over some of them. First up, we have the buyback of shares. This occurs when a company repurchases its own shares from the market, effectively reducing the number of shares that are outstanding. This process involves various steps including obtaining approval from shareholders and regulatory bodies as well as making the necessary disclosures. Another method is the conversion of debt or preference shares into equity. This allows companies to convert the existing debt or preference shares into equity, often providing relief from financial obligations and improving the balance sheet. Corporate Debt Restructuring (CDR) is a scheme that is aimed at helping viable companies restructure their debt to avoid becoming non-performing assets. It involves renegotiating debt terms with creditors under the guidelines set by regulatory authorities. Leveraged buyouts (LBOs). It involves acquiring a controlling stake in a company using borrowed funds. While this can provide opportunities for growth, it also comes with risks, including increased pressure to perform and potential loss of ownership control. Equity restructuring focuses on strengthening a company's equity base through actions like stock dividends, splits, or reorganizations. This can help boost shareholder confidence and align share prices with the company's earning potential. Divestiture and disinvestment involve selling off parts of the business or withdrawing investments. These strategies can help companies refocus on core operations, raise funds, or adapt to changing market conditions. Finally, companies may opt for changes in their entire capital structure, and this involves a comprehensive overhaul to achieve a better balance between debt and equity, ensuring financial stability and maximizing shareholder value. So, in summary, financial restructuring plays a crucial role in reshaping a company's financial landscape by employing various methods that are tailored to their specific needs. And thus, companies can enhance their financial health, drive the growth, and create value for shareholders. So, if you have any questions about these methods or anything else that are related to corporate restructuring, feel free to post them in the comment section of this video. So with that, we have covered all the major aspects of financial management as stipulated in MMPC 14 of IGNOU MBA as per the new syllabus. And whether your specialization is banking, finance, or something else, money matters in business, okay? So I need not stress why understanding these concepts are crucial for us MBA graduates. Thank you so much once again for tuning into Anu's Classroom. I hope you have subscribed to the channel and enabled the notifications. And I really hope that you found the session worthwhile, worth your time. So let's catch up in the next session. Until then, thank you. Take care. Bye-bye.